Deal or no deal? Well, actually, 5 no deals. This week we're going to take you through 5 deals that we've turned down this year so you can learn all the lessons and apply them yourself.
Welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. As part of the business we run, we look at a lot of deals, like a lot. And this week we're going to dish the dirt on just 5 that we've turned down. We're going to take you into the specifics of deals that at first looked completely fine, but on closer inspection, we just couldn't do. So that's coming up after the news, and stick around to the end because in Hub Extra, we've got a resource that's going to make those conference calls from home a little bit more bearable.
So a super positive news story this week. After so much doom and gloom in the property market, it's nice to bring you a news story like this, which is a sign of that things are moving in the right direction. The headline reads, Virgin Money relaunches buy-to-let deals of up to 80% loan to value. The reason why this one is particularly significant, Rob, is loan-to-value levels for buy-to-let products normally cap out at 75%. There are some that go higher, but the main market, most of the market is at 75%. So to see Virgin Money not only being confident enough to bring their 75% products back, but also 80% loan-to-value is just really, really good.
Yeah, you can normally take 75 as being your kind of average, and if lenders are feeling cautious, it might go lower. When they're feeling optimistic, it goes higher. And we've seen it go over-optimistic and get up to 100% and beyond in the run-up to 2008, and we saw how that ended. But anything above 75% generally means that lenders are feeling pretty good about the market, or they are particularly keen to win business. So the fact that the mortgage market is reopening is positive in itself. Lots of the products that went away have now come back again as lenders have managed to adapt to this new way of working and get some confidence back. But the fact that Virgin have gone above 75% shows not only that they're keen to do business, but also that they're presumably not overly worried about serious or prolonged falls in prices. So we can definitely take this as a good sign. As a property investor, you want to be doing deals. It's doing the deals, buying the property that makes the money. And let's be honest, it's the really exciting bit as well. But there are lots of reasons not to do a deal. We talked back in episode 332 about reasons that we would walk away from a deal, and we'll link to that episode in the show notes. But as you might know, one of our businesses is called Property Hub Invest. That means that we're constantly seeking out new deals that we could bring to our clients. But after diving deep into the specifics, we end up turning down the vast majority of them. So in this episode, we're going to look at 5 real examples of deals that we've turned down. Because of confidentiality, we can't name the development, so you can't go away and Google it. But we are going to give you as much information as we possibly can about the circumstances surrounding the deal and exactly why we turned it down. And the idea is that by hearing about these deals and understanding our thought process, you'll develop a better idea of what you should be looking at when you're looking at deals. Even if you're not operating on the same kind of scale, the principles are all the same. So Rob, let's get into the first deal that we turned down. And it wasn't an easy one to turn down because it's in a city where we always want to do more, and that is Leeds.
Yeah, absolutely. We love Leeds. Now, with the 5 deals that we're going to go through today, we were happy with the area of all of them. The area was absolutely fine. They were in our target areas. There are so many more deals that we just turned down in an instant just because they're outside of our target areas. They've not made it onto the podcast. These were ones that were painful to turn down because we wanted to do a deal. But for one reason or another, which we're about to go through, we stopped. So the first deal in Leeds seemed on paper the dream setup. It's in the city centre. It's with a developer that we've worked with before. So we know what they're like, they know us, and they had the chance to buy a piece of land in a great location of Leeds. And it came with existing planning. So on paper, so far, this looked like a dream come true. The price they needed to pay for it compared to the amount of units that they had, the price that they had to pay for the land, the price that they would sell it to us for worked. They could make a small profit, which they were happy with. So we started to get more information. We started to do a bit more digging. Now, part of that information and part of that digging is to look at the plans. And that's where, for now, this deal has fallen down. Because we will often see deals with existing planning in place, and a developer asks us to review the deal before they purchase the land. And as you can imagine, over the years, I've seen hundreds, if not thousands, of different floor plans. And I would have to say that for an apartment scheme, these are probably the worst plans I've ever seen. The worst. It was like a child had put them together, but a child who was having an off day. They were so bad. The so-called one-beds, which turned out actually to be studios, as you opened the door, you walked into the kitchen. Not the welcome that most people would want. And it was worse beyond there in terms of the lighting, the corridor layouts outside of the apartments. I just don't know why anybody would have chosen to design this development like they had. It's like they hate Leeds or hate the area or hated the client that they were working for. I don't know. Now, this meant that this would need completely reworking from a planning point of view. And it's something that the developer we work with may decide it's worth doing. But it's going to need a lot more work before we can look at it again. So for now, that one's turned down.
So for those plans to get through planning when they're that bad, do planners actually look at things like how desirable the units are going to be, or to look at it to the extent of, or why would you want to be walking into the kitchen, or why is the corridor like that? Or is that not something they look at because as long as it meets regulations, it's like, well, if you build something rubbish, that's your problem?
My assumption before I got into this world, Rob, or as I entered this world, was that when something gets planning, it should be, of a reasonable design. Why would they allow it to pass? But it's actually something that you can build. And the reason I say that is on our own sites, our first development and our second development that we've personally developed on, it turned out that the existing planning that was in place was impossible to build, that it wouldn't meet building regs. So no, they do have input on the size of the scheme, it seems, and they do have input on the external look of the schemes, and they seem to have a view there. But whether it can actually be built or internally, the layout, there seems to be less interest. Now, there are different planning authorities for different areas, and they're not all going to be created equal, and it depends on who was working on that project within that local planning authority. So it's not to say they're all that bad, but it's amazing what you see come through, like truly astonishing. It's like no thought has gone into it. It's poor, yes, for the planners to approve it, but who are the architects putting these things through? Stuff that can't be built or stuff that's terribly designed. Like, why are they in business?
Presumably, if it was being sold with planning, then whoever owned the land just wanted to make the scheme look viable, right? They probably didn't want to spend big bucks on architects to make it amazing, as long as it looked like they could sell it.
It seemed so. It seemed like they tried to stack as many units in as possible to maximise the price point.
So if you didn't have the experience you had and were able to spot this, or if you were a bit evil and you thought, well, I want stock to sell and I can sell them anyway, and you just agreed to it and waved it through, do you think the developer would have noticed, or would they have just gone ahead as planned?
Because we know the developer, they certainly would have improved the scheme. But the reason why they bring it to us in the first place is because they want to know, is it going to work? So that in itself suggests that they wouldn't have gone ahead. But as a minimum, I'm sure they would have improved the scheme. The reason this deal might not happen now is their offer will go back and it'll be subject tos. So subject to it being replanned. And the seller may not want that. The seller will probably want a quicker sale. So we'll find someone who will build it out with the planning close to as it is, or it'll be someone who's prepared to take that risk on and buy that development and then hope they can get a better planning scheme through at a later date. And we might not have a relationship with that developer to do a deal. But there are some really poorly designed schemes out there, that exist right now. So could it get through? Well, in theory, yes, it could. I really hope it doesn't. It would be a shame for Leeds if it does.
Okay, so that was an off-plan deal that had to be turned down. And there's a misconception that Property Hub Invest is all about off-plan deals. But that's not necessarily the case. We do source existing stock as well. In some cases, existing tenanted stock that's been operating for a few years. This next deal is an example of one of those. And if Leeds was hard to turn down, Rob, this must really have been a dark day, because this one we had to turn down in Liverpool.
It was really dark, Rob, because not only did we have to turn down this deal, but we actually lost out on a deal before getting to this point. So the backstory to this opportunity was that, again, we have a great relationship with the developer. A different developer now, but a great relationship. And we want to do business together. So they had a scheme in the business area of Liverpool, the business district. Again, tenanted stock. And we put together a competitive bid. But there were other people putting bids in as well. Now, we lost out on that deal, unfortunately, to somebody who's going to go in and buy cash. And the way we work is our investors will go into a deal and some of them will use mortgages. And that's absolutely fine because leverage is a great thing. So that made our proposition look a little less attractive to them. We were more attractive in other aspects and it was very close and we were down to the final two parties, but we lost out. But as the developer really wants to do business with us, they immediately offered us another development in Liverpool. Again, stock. Again, tenanted. We were excited, right? This is us, but the only bidders right now. Let's see if we can do a deal. So we looked at the stock and our hearts sunk because whereas the first deal, it stacked up on every level and it passed our research criteria, this one quickly fell down. Because while these apartments were beautifully converted and beautifully updated, the developer didn't own all the apartments in this block. And on Rightmove, there were some units that were nowhere near as good condition, but the pricing was all over the place and there were some repossessions in there. And therefore, rightly or wrongly, it gave the perception that the units they were offering weren't priced right. Now, that's okay because often we'll go into a negotiation and it's not priced right. And we will speak to them over a number of days, weeks, and sometimes months. And sometimes we're able to get to a price that we're happy with. So while we weren't happy with the pricing at the beginning, there may have been a deal to be done still if they were willing to come down on their price quite a bit. So we didn't dismiss it on that alone. But then our research continued. And when we look at a development, we do the simple stuff, but the simple stuff not everybody does, which is like Google that development, particularly if it exists already. Is there any news? Is there any information on that development? And unfortunately, there was a bit of negativity around that development for different reasons on the internet. Some valid and some probably a little unfair. But negativity around any development scheme, built or not, isn't great. And unfortunately, that existed. And finally, it looked like in the past that it had been marketed out to investors online. When we launch any investment opportunity to our clients, it's done completely offline. You don't find any of our investments on the internet. If you go to the Property Hub Invest website, you don't see any deals on there. It's all offline. And there's a lot of reasons for that. It can hurt mortgageability, for example, if it's plastered all over the internet. And in the past, this deal had been on the internet, which could have caused some issues for mortgages as well. Small risk, but with everything else as well, it just all stacked up to making it not worthwhile and a deal that we wouldn't pursue. So disappointing, absolutely, because we missed out on two there.
It must have been particularly hard as well because these are not the only two deals that have been turned down in Liverpool. I know from the conversations we've had in the past that we see loads and loads in Liverpool, but Liverpool seems to have more developments than most that for one reason or another you wouldn't want to get involved with. This one seems quite subtle. It's one that easily could have ended up getting into because it didn't trip any major flags. But I know there are plenty of others that are plastered all over the internet and structured in some pretty bizarre ways.
Yeah, you have to be really careful with Liverpool because developers have realised that investors are now interested in Liverpool. And Liverpool is starting to become, I wouldn't say it's hot yet, but it's starting to become a hot market that they are marketing to investors. And there are a lot of questionable schemes there and from some questionable developers. A lot of shiny websites, but not great track records. When you actually look into who's developing these projects, they haven't done a lot, if anything, before. And the way the deals are structured in terms of the deposits required, again, is unattractive. You have to be really careful if you're paying more than 10% in a deposit if you're buying off plan. A lot of these deals in Liverpool require 25%, even up to 50% deposits. And just recently, there's been another scheme, and unfortunately one of many, where they were taking larger deposits. And that scheme looks like it's in serious trouble. And I worry for the investors who put those large deposits in. So a general lesson is always do your research. Always do your research wherever you're looking. But if it's in a city or location where investors are particularly keen on, remember, sharks will start to circle and they will take advantage of naive investors. So do your research. Look into the developer and do not put more than 10% down on an off-plan development, even if they tell you it's protected, because quite often it isn't.
So let's say for this particular deal, it had never been on the internet. So the only issue is the pricing, and we obviously can't say what the development is, but I'm looking at it on Rightmove now and I can see that the prices do seem to be all over the place. If you could have got the prices down to what you believed was a fair level, would you have done the deal in that case? Or would you be put off by the possibility that a valuer might take a view that is more negative, or perhaps just be way overly cautious and value it at the price of the cheapest flat they can find in that block just to be on the safe side?
we would have played it on the safe side. That's the way to do these things, is just play on the safe side. Now, luckily, as I mentioned, we knew the developer, so they weren't going to start getting upset with an aggressive offer. So it wouldn't have stopped me. I would have put the offer in because we would have been able to evidence why we put that offer in and explain it to them. And we'd gone very aggressive on the previous deal with them as well. And we still ended up in the final 2 bidders. So we've got no problem on pushing on price. We are fussy. When we are able to do a deal, then we can all get very excited. Unfortunately, as you're finding out, it can be quite hard to do a deal when your criteria is so tough. Now, where we had a relationship with the Liverpool developer, in our next deal in Derby, we didn't. We were introduced to them to speak to them for the first time. And Derby is great. Amazing city centre, really wealthy. When you start to look at the wages in Derby, the fundamentals in Derby, the building restrictions they have there, it's a really interesting market, really interesting. And one, as property investors, you should probably consider. So we looked at this development, had a great spec, great development, and they wanted to do a deal. We looked at the prices, and they were way off, way off. But as I've said, this happens a lot. So before we got any further, we needed to put it to them that their prices were way off. Well, it turned out they got a bit emotional over our valuation of the site. And when I say a bit emotional, they stopped talking to us immediately when we told them what we thought their site was worth. And that's before doing a discount. So we were just trying to agree on what it was actually worth. Never mind doing a deal on that number. So it ended up, even though it's a development we love and an area we were really attracted to, being a non-starter really early on. And that happens because sometimes developers get emotionally attached to a number in their head, or they've paid so much for a piece of land that they've convinced themselves that it's worth this amount. And then when someone tells them it's not, or they don't believe it is, they get quite sore about it.
So I'm looking at the design and the spec for this development, and it does look amazing, really strong. So how do you rule out the possibility that they are just establishing a new price point here and they might actually be worth that value? I know that this isn't a part of business where you want to be overly optimistic. It doesn't pay to be so. But how do you get certainty that you're not ruling out something unnecessarily?
You're right. Sometimes developments do come in and set a new price point for an area, higher than what was there before. And could have this development done that? Possibly. It's possible that could have happened. But it's the amount of uplift that they wanted to achieve for that immediate area that put us off. So they wanted to achieve 20% more than what was being sold locally. That's a huge uplift. And there's another new development close by that had started at higher prices and had reduced them over the last 6 to 9 months down to where they are now, which is about 20% less. And that's a really nice scheme as well. Maybe not quite as nice, but not far off. There's not anything noticeable there that you go, wow, okay, these are chalk and cheese. They were both really good developments. And they too had tried to achieve higher prices in that area and set a new price point, and they failed. So if this developer had tried to push it up a smidge, maybe 5%, then, there could have been a conversation there. But as they were so way over, and then we also wanted a discount as well when we got them back down to planet Earth on what their pricing should be, it was just never going to happen.
Okay, so let's move from one deal where price was the main stumbling block to another. This time in Manchester, again, a city where there's huge demand, where we really want to do deals. But like Liverpool, there are lots of schemes in Manchester, some of them very, very good, but a few not so good. Maybe over-optimistic, or maybe well aware that that demand is there and trying to cash in. And on this particular one, Rob, it sounds like the price was just way off.
So unlike the deals that I talked about in Liverpool before with the high deposits and the developer not having a great reputation, that wasn't the case here. The developer has a great reputation. They were willing to accept 10% deposits. They were completely protected. So as an off-plan deal, in terms of security, we were confident. Where this just fell down straight away for us, like you said, Rob, is the price point. It was just hard to justify the values. And even though they had achieved sales at that amount, we still felt that those sales were probably coming from overseas investors who knew less about the local market and were just enticed by the very glossy, and it was very glossy, marketing. The great thing about somewhere like Manchester is that you have a lot of comparables to work with. So Derby was more difficult because there isn't as much being built there. But in Manchester, it's a huge city centre and there is a lot happening. And we know Manchester really well. So we can immediately reference other schemes that we've worked on and been happy with and see, how does it stack to that? And I'd say more than 9 times out of 10, 9.5 times out of 10 in Manchester, it comes down to price. People are getting overly ambitious with what they think it should sell for, and they're pricing schemes at higher and higher amounts. Can you still do a great deal in Manchester? Yes, absolutely. But is it hard work, and do you need to do a lot of research? Yes, absolutely. Just shopping around on Rightmove isn't enough. When a market has attention like Manchester, you really need to do your research and go, well, what is the best price development in this area? Not just, is my development reasonably priced, but as there are a lot of developments there, go, okay, what am I paying price per square foot? How does that stack against the other developments? Now, how do my facilities and services in that development stack? Some developments are getting put up in Manchester that have a nice spec, but zero facilities, and are pricing it against developments with swimming pools and gyms and everything else, and all the other exciting toys and features. Again, doesn't make sense. So there's a lot that doesn't make sense in Manchester, and unfortunately, it makes it very hard to do a deal.
Another factor with this particular development was that it had already been marketed, not just overseas, but had been marketed in the UK as well. And again, we can't name any of these developments, but I've just Googled it. And in seconds, I've just found 5 different companies already that are marketing this exact same development. We often say that's the reason we don't like a deal, but it's probably worth recapping, Rob, why that can be a problem.
The main reason is mortgageability. If a development is plastered all over the internet, when a surveyor does their research and they type in the name of the development into Google, which the vast majority of them do, they will then see that that development has been plastered all over the internet and marketed towards investors. That means that scheme is probably being sold in its entirety to investors. Now, in the city centre, you can expect and should expect a development to have a lot of buy-to-let investors in. But when it's the entire development, that can make some surveyors nervous. And that can cause down valuations, or for some lenders, they'll instruct their surveyors to give it a valuation of 0, which means basically it's unmortgageable. There are schemes in Manchester, London, and all the other major cities that you can think of that are unmortgageable. And that means those investors who were already putting in, quite often big deposits are now having to find the cash for the rest of the scheme. And this is an area that we spend a lot of time up front making sure that a development is going to be acceptable to lenders. And we don't just cross our fingers. We speak to mortgage brokers, and then if the deal goes further ahead, we actually invite surveyors onto the site early on to approve the development. It's not something we've always done, but it's something we've done over the last couple of years. And we found the results of that have been fantastic. And it's meant that the sites that we've worked on, you've been able to get mortgages. Now, with any site, whether it's investor-led or it's got owner-occupiers, there are always going to be lenders that won't lend on a development. And that's got nothing to do with the amount of investors on there. It's just their criteria. But over the last few years, we've been able to get mortgages on all the developments that we've done off-plan, and it's because of that work up front. And Rob, I think it's worth saying as well that one of the reasons why it can be difficult for us to put a deal together is that we insist on exclusivity. Because once we know a deal is great, we know our investors are going to snap it up, and we don't want it advertised elsewhere, and we don't want anybody else bringing down the credibility of the site. And that's because we have a great deal. But that leads you to the question of, why are these developments plastered all over the internet? Are they really a great deal if they're having to market so heavily? When we secure a deal we're happy with, investors, and educated investors, because they listen to the podcast, will snap the deals up. And that's fantastic. But the deals we turn down are the ones that you see all over the internet. Are they great deals? Well, if they're being marketed by multiple companies and they're all spending a lot of money on marketing, the answer is probably not. They might be okay, but they're not great. If you have to really sell a deal, how good is it?
So we've just been through 4 deals that we've turned out, all for slightly different reasons. The 5th and final deal we're going to look at is in an area that we specifically tipped at the start of this year, where we really want to do a deal. But unfortunately, this one sounds like it was turned down for all of the above.
Yeah, so the location was great. It was Bolton. Greater Manchester is an area that we're really targeting right now. But this fell down on so many reasons that the guys in the sourcing team didn't even show me. So that's how bad this one was for us. Because the price point was inflated. It was heavily marketed online, and they were asking for big deposits. There's a lot wrong here. And it was an office conversion. Now, some office conversions are fine, but if it looks like a 70s office block and it's being converted into a development and looks like a 70s office block afterwards, then you probably should avoid it. resale values aren't going to be as impressive in the future, but also it sometimes can cause mortgageability issues. Now, that doesn't mean you should avoid all commercial conversions into residential. You just need to be very picky on what you accept. It needs to look like a home, not a commercial property that looks a bit like a home. So that's a general piece of guidance there. Sometimes, Rob, you see all the boxes with X's in, and people may be surprised how often that is, but actually, this fifth and final deal in Bolton, we see loads of deals like that. The area was right here, but beyond that, pretty much everything else was wrong.
So we've talked about 5 deals there. And the scary thing for me is if you put aside the first deal in Leeds, which might end up not being built at all in its current form because of the issues you highlighted, all the others probably will sell. And they probably will sell at close to the prices that are being asked. So for those deals where we've highlighted price as being the main obstacle, okay, the developer might not get quite what they wanted, but it wouldn't surprise me if they got somewhere near. And the other reasons that we've highlighted for walking away, those issues aren't going to go away. And those properties will be sold. So I think it shows how careful you have to be. And also how few actually work. Because we've talked about just 5 here. But Rob, of everything that we look at, what proportion do you think actually makes it through?
Unfortunately, we turn down about 90% of the deals reasonably quickly. So we only get into negotiation on about 10% of the deals that we look at, which is really low. But then we might not do a deal at all. So we fortunately see dozens of deals every single week and negotiate on hundreds every single year. But we probably will only launch to our investors 16 to 20 across a year, which is really small when you think about it. And we are hurting ourselves by not launching more. And a common complaint we get is that we don't launch enough stock. But our reputation is really important to us. And we want to be around in years to come. And not everyone who's selling these deals and not all these developers that are developing these properties will be. And that changes their motivations.
Yeah, like I said, the majority of these deals that we've decided against will end up happening in something like their current form. And that's because the incentive of everyone involved is for the deal to happen. Developers obviously want to get rid of their stock at the best price they can. Can't blame them for that. And any agents or other parties involved are somehow being compensated when the deal happens. And that doesn't mean that they're bad people necessarily. It's just that when you have an incentive to see the world a certain way, you are more likely to overweigh certain factors in your mind, maybe pay less attention than you should to others, and come to a view that is consistent with what you want to be true. And of course, as an investor, you want to do the deal as well. Nobody looks at an opportunity. Nobody walks into a viewing thinking, God, I really want to find a reason not to buy this property. You want it to work because you're spending your time on it. And if it doesn't work, then you're going to have to go and spend even more time looking at other deals, doing more research. And if you just say yes, it means that you've taken a step closer to what you ultimately want to achieve. So everyone, including the investor, wants it to happen. But as the investor, it's your job to find reasons not to do the deal, to ask all the difficult questions and to really challenge it. We always make a point of saying, here's our research, go away and research our research. This isn't us telling you the absolute gospel for how it is. This is us telling you what we believe. You might believe differently. So working with a company like ours or any other is not an excuse for not doing your research. In our case, it's a way of having the vast majority of the deals that won't work weeded out before you have to look at them, as we've already seen. But it doesn't mean doing no research at all. And if you're sourcing deals for yourself, the criteria you're using might be a bit different. The reasons for rejecting a deal might be a bit different. But it doesn't change the fact that the majority of deals aren't deals that you should be doing. So if you are sourcing your own deals and you're looking on Rightmove and finding most stock you're not interested in, if you are then going to the viewings for properties that you are interested in and finding then that they don't work for some reason you weren't aware of, and if you're then putting in offers on the properties that do work and getting most of them turned down, it doesn't mean you're doing anything wrong. It's normal. And in fact, it means you're doing your job as an investor right.
So Rob, as I've recorded this episode today, there's been builders out there somewhere that have really loved drilling and making a lot of noise, because we don't record our podcasts most of the time in studios. Most of the time we record from home, and that can present challenges. So this week, not only have you got a resource for everyone else working from home or who occasionally works from home, you've got a resource to help us out.
Yeah, this is really cool. This is an app called Crisp. That's KRISP.ai is the website. And it's a piece of software that detects and silences any background noise. So we use it in our offices where there are people who are on the phone a lot and there's always lots of background hubbub. So they use it so the people they're speaking to don't have to listen to all that. And I've used it when I'm out and about working from cafes. I might be out somewhere noisy because I'm not expecting to have a call. Then something comes up. Then I have to jump on a call, I turn the software on, and it sounds to the other person like I'm in an absolute pin drop silent office. It really is amazing how well it works. So this is a service that you have to pay for, but you do get 2 hours a week for free. So if you're working from home and you've just got the occasional important conference call with someone who you don't want to hear the kids fighting in the background or hear the washing machine spinning, then you might not have to pay at all. And it's definitely something worth checking out. That is us done for this week. Hope you found this episode useful. And if you're in the mood for more property education, remember there's a whole world of resources at propertyhub.net, which is home to the forum and articles and all our completely free video courses. And if you're not already, make sure that you're subscribed to us over on YouTube, where we're constantly dropping new videos. So plenty to keep you busy until we see you next. Until then, bye-bye.
Bye-bye.